Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick, Caroline Hyde, Taylor Riggs counting you down to the closing bell, and here to help take us beyond the bell. It's our global simulcast. We're joined now by Tim Stenovec. And if my eyes don't deceive me, I believe Carol Massar is finally back from her 3-week-long sabbatical across the high seas. We welcome our audiences across Bloomberg Television, radio, and YouTube on a day, Carol, where we saw a lot of buying here at the start of the session.
Yeah.
That faded in the middle of the session, and now, as you get closer to the close, those bids coming back in.
Yeah, absolutely. Kind of interesting to see across the board that we're seeing some buying here in the final few minutes. Megan Horniman over at Verdant's Capital Advisors was just on with us, though. She's keeping an eye on the VIX, and she said you need to see the VIX, though, consistently to hit 40 to really maybe say we're at the capitulation phase. And right now we've got the VIX at 26 and change, Tim, so not even close.
She also says, get used to what we saw today because it's going to be an ugly market, at least until the next Fed meeting. We're going to see a sideways choppy market until we get clarity from the Fed. But I countered that, it kind of seems like we're hearing that over and over again. We're looking for clarity. The market's looking for clarity, and it's not necessarily getting that clarity. We're always looking for that next eco data point or that next Fed speaker.
And they're getting worse, not better, and which also means that the bond market really isn't providing a lot of the clarity either. Caroline, we talk a lot about the 2s, 10s and the deepening inversion. The 2s, 30s had some of the biggest inversions that we haven't seen since 2000, as yields on the front end are really going up to the highest that we haven't seen since about 07. So certainly some big superlatives when you mention years like 2000 and 2007 and what it means for this inverted yield curve.
33 bips, Romaine.
All right, well, just an hour or so ago, it looked like we were headed for a down day here, a second straight day of declines, and that's going to buck that trend here. The S&P 500, the Dow Jones, and the NASDAQ all finishing higher. The Dow Jones Industrial Average up by about 0.1%. The S&P 500 higher by about 0.3%, while the NASDAQ Composite is up about 0.7%, and the Russell 2000, not to be left out of the party, up about 0.4% here. So some decent gains across the board, though nothing that's really going to have anybody change, I think, their opinion overall, Carol, about the direction of this market.
Yeah, despite the ups and downs, I agree with you that at the end of the day, I don't think there's anything there to significantly sway us in terms of our views. Having said that, the S&P 500, almost an even split, Taylor, 226 names actually gaining in today's session, 275 to the downside, 2 unchanged. And when we get into the gainers, I know you're going to look at some of that too. There really were some outperformers today, despite the up and down.
Let's get right into that, Carol. I like that you talk about some of the outperformers. It's autos and it's energy. You're up 3% on the day as well. Semiconductors and some technology, hardware and equipment is up there as well, up about 1% or so. For the radio audience, we also take a look at the sector underperformers as well. It is transportation. We've been talking a lot about some of the rail strike, of course, that maybe Amtrak and the likes are preparing for. That sector off more than 1%. And then real estate in there as well, as we're really continuing to digest what higher yields mean for that sector.
All right, let's get to some of the gainers, the specific gainers in the Wednesday trade. We talked about this, Romaine mentioning Starbucks earlier. This stock finishing just off its highs of the day, up about 5.5%, top in the S&P 500, top in the NASDAQ 100. Company coming out, raising its 3-year outlook for profit and sales. They did this at that annual presentation to investors. Also talking about resuming share buybacks in fiscal year 24. So a lot going on with that name. Another one top in the S&P 500 and NASDAQ 100 was Moderna. This, again, we talked about earlier. Reuters reporting that the company looks to have held talks to supply COVID-19 vaccines to China, though no decisions have yet been made, but keeping an eye on that one. And Twilio, some outperformance, mega outperformance, up 10% in today's session, announcing a plan to eliminate about 11% of its current workforce. That drew some support from analysts. Keep in mind, the stock, Tim, is still down about 70% year to date. Yeah.
People getting laid off, and then the Twilio shares higher by more than 10% today. Hey, you got the gainers, Carol. I'll take a look at the decliners. We start today with Union Pacific. Shares finishing the day down by 3.7%. We are keeping a close eye on what's going on with this potential railroad strike. We did learn earlier in the day that Amtrak is suspending long-distance service tomorrow as a result of what could happen with a rail strike. Goldman Sachs saying this afternoon that a rail strike could cost Class 1 railroad operators about $1.8 billion in revenue just for the week. Goldman also said it would contribute to inflationary pressures in the country. I mean, if the oil is being transported by this and it stops, that could be an issue. Nucor, the worst performer on a percentage basis, down 11.3% in the S&P 500. The largest American steelmaker fell short when it came to expectations for the third quarter. It said said that metal margins are shrinking and they're seeing shipments decline. Could be a sign of waning demand when it comes to the U.S. economy. And then Meta Platforms finishing the day down by more than 1% today. Shares hit a 52-week low yesterday, fell more today, hitting another 52-week low today at their lowest level since March of 2020, down 60% from their highs last September.
And of course, Tim, Meta has been under pressure because of that inflation read yesterday, because of rates going higher. And indeed, the inflation pressures don't seem to be pulling back that much when you look at the commodities spectrum. Natural gas jumping almost 10% at the moment, lifting over in Europe as well, as we look to Europe trying to tamp down some of the most aggressive parts and trying to cap market prices, trying to stem demand. But at the moment, natural gas certainly pushing higher in the US. And indeed, as you say, oil on the upside, up 1.6%. And this is perhaps we look to maybe an alleviating of some of those shutdowns in China and Chengdu in particular, maybe shorter than had been previously expected. And I mean, overall, having been beaten up so much yesterday, also, of course, talk that maybe the US starts to fill up their reserves again. I'm looking at what happens in the foreign exchange market, because yesterday we were talking about King dollar on top. Today, we give a little, only by 0.2% weakness in the US dollar index. And instead, we see finally some sort of reprieve on the Japanese yen that has been lower, 24-year low. We get a bounce back as maybe the talking, the signaling from Japanese monetary policy makers, the government talking about trying to really push this currency higher once again. Verbal, will it become practical? We look at the British pound up 0.4% as well as their inflation actually dials back a little bit. And sovereign bonds, I mean, again, it felt like it was a move out of debt, whether you be in Japan and New Zealand and indeed Australia. A little bit of buying in Europe, Taylor.
You're seeing, I guess, maybe a mixed picture here. It is stunning, the moves that we're seeing on the 2-year yield after the huge lift up yesterday of about 18 basis points. A continued relentless push higher, 380 on a 2-year yield, up 4 basis points on the day. You're up 3 basis points on the 5-year. And then 10s and 20s are flat. A 30-year yield catches a little bit of a bid. So that is pushing the headline catchy number, 2s, 30s to the most inverted this century. I guess we'll use the year 2000 to keep it all in perspective. But really incredible the levels of inversions you continue to see.
Yeah, and now this has really gone from just being about Fed policy to really about economic conditions, whether you're betting on a soft landing or betting on what some people now seem to think is a recession, at least by the start of next year, if we're not already in it right now.
Yeah, that's the thing, right? I mean, technically, right? Are we in a recession or not? I don't know.
Do you know how they do that at the NBER? I saw this fascinating documentary about it. It's very clandestine.
What can you share with us?
I don't know. You have to watch the documentary.
There are like 9 indicators, right, that they look at, right?
Yeah, they look at a variety of indicators, and they kind of meet. And it's a pretty high-level discussion, and I know everyone sort of likes to make hay about it, but I think these standards are important, at least from a historical look back, to be able to see when these cycles begin and end.
Well, one of the most important indicators, and I go back to this time and time again, is the labor market. And even though we see this anecdotal evidence, Twilio, for example, especially coming from Silicon Valley, and hiring slowdowns and hiring freezes, I brought this up earlier with Megan Horniman. I mean, the labor market still is just delivering really, really strong numbers month after month. So it's hard until we see some weakness there to sort of think about the fact that
it's sort of been that drip. We heard from Google earlier today saying that they were kind of getting rid of that area 120 or whatever, A120 unit. And, that's all, I think it's only like 100 or something, so people that would be affected. But, I mean, it's significant when you add it all up.
Yeah, some of the key innovation areas of some of these companies really starting to dial back a little bit. And there has been some great pieces by Tyler Cohen, for example, our opinion writer, saying really you should be worrying about the US workforce. That's a bigger problem at the moment. You pointed out yesterday it's about a white collar issue that we're going to see first and foremost. How quickly that starts to dial up into the market at the moment, because wage price spiral is still very much something that we're trying to address, that people are worrying about at least.
The only caveat to that, we were talking to a private equity guest today saying they've only cut valuations on their end by about 5%. They're not really having to tell their portfolio of companies to hoard cash, that margins on that end have been stable. Now, of course, that's just other anecdotal evidence, and we'll look for the real data as well. But you certainly are hearing both sides.
All right, so 1 month from today, we will get earnings from JP Morgan. So I'm starting to think about, let's get through that Fed meeting, right? There's obviously economic data points, but now what will be the next kind of layer of conversation that we get from the C-suite specifically about cutting back margins? I mean, that's kind of what I'm starting to think about to get an idea of what's next for us? Are we going to hear a lot of recessionary talk from CEOs, Tim? I mean, I'm thinking a lot about that.
Well, look what we got from the Business Roundtable earlier when it comes to CEO sentiment. I mean, I think that gives us a little preview of the types of commentary that we're going to hear from these CEOs when they start to report earnings and say, hey, we're holding back on hiring, we're holding back on CapEx spend because we're concerned about the economy.
Yeah, exactly. Think about what McDonald's said today and the CEO. So, all right, guys, we got to run. That's a wrap for our cross-platform coverage. Beyond the Bell, live on radio, TV, and YouTube, counting you down to the bell. We will see you again, same time, same place, tomorrow.